Today our training session about syndication and funding in banking segment, in capital flow. After completion of this session we hope that you will get an idea about syndication and funding. Our services. Our experts will help you in providing assistance from term loans to unsecured loans. We at Syndication and Funding provide following services: term loans, working capital, collateral-free loans, bank loan syndication, business plan preparation, CMO reports, bank loan rating, credit score check and repair, secured loans, unsecured loans. Term loans. A term loan is a standard commercial loan from a bank for a specific amount that has a specified repayment schedule and a fixed or floating interest rate. Term loans are provided for acquiring or constructing or installing or establishing capital assets, which will provide returns over a period of time. Term loans will also be repaid in regular payments over a period of time, as the asset generates returns. Term loans are usually provided for acquiring or constructing building and acquiring or installing plant and machinery. Term loans divided into two categories. Intermediate term loans. Usually the time period is running less than 3 years. These loans are generally repaid in monthly installments from a business's cash flow. According to the Bankers Association, repayment is often tied directly to the useful life of the asset being financed. Long-term loans. These loans are commonly set for more than 3 years. Most are between 3 to 10 years, and some run for as long as 20 years. Long-term loans are collateralized by a business's assets and typically require quarterly or monthly payments derived from profits or cash flow. These loans usually carry wording that limits the amount of additional financial commitments the business may take on, including other debts but also dividends or principal salaries, and they sometimes require that a certain amount of profit be set aside to repay the loan. Documents required to obtain term loans. For salaried applicants, proof of identification, PAN, Aadhaar, driving license, voter ID, proof of income, pay slips, Form 16, IT are filed forms, for 3 years, address proof, electricity bill, telephone bill, gas bill, not less than 2 months, passport, ration card, proof of employment, employee ID, existing loan details, bank statement, for last 6 months. For companies, proof of identification, PAN of company, address proof, electricity bill, telephone bill, office address and ownership proof, proof of business existence, sale deed or agreement, company registration license, copy of tax registration, proof of income, IT are filed forms, audited financial statements, bank statement for last 1 year, passport size colored photograph, existing loan details, copies of all property documents. Before providing loans, bankers will check the following 5 C's. 1. Character. How have you managed other loans? Business and personal. What is your business experience? The borrower's reputation and perceived trustworthiness. 2. Credit capacity. The bank will conduct a full credit analysis, including a detailed review of financial statements and personal finances to assess your ability to repay. The borrower's ability to repay the loan. 3. Collateral. This is the primary source of repayment. Expect the bank to want this source to be larger than the amount you're borrowing. What assets the borrower has to offer as insurance in the event of a default. 4. Capital. What assets do you own that can be quickly turned into cash if necessary? The bank wants to know what you own outside of the business: bonds, stocks, apartment buildings that might be an alternate repayment source. If there is a loss, your assets are tapped first, not the bank's. How much money the borrower has put toward the investment. 5. Confidence or conditions. How accurate are the revenue and expense projections? Expect the bank to make a detailed judgment. The conditions of the loan the borrower is seeking, as well as the current state of the economy in general. Working capital. Working capital is a fundamental requirement of every business. without which its very functioning is at stake. Working capital loans are provided for financing everyday operations of a company and used to cover or build up current assets like inventory, stock in trade, accounts receivables, etc. Companies that have high seasonality or cyclical sales cycles usually rely on working capital loans to help with periods of reduced business activity. It refers to the current assets of a company that has changed from one form to another in the ordinary course of business. A working capital term loan is accorded to extend long-term working capital credit facilities to entrepreneurs so as to assist them in addressing issues such as irregular cash flows, non-availability of cash reserves, etc. Working capital is equal to current assets less current liabilities. Working capital management. Inventory management. Inventories basically include the raw materials, WIP products, and finished goods manufactured or bought from the suppliers. Where the company buys excessive stock, it places a heavy burden on the finances. Similarly, if the inventory isn't available on time, it will lead to the loss of sales. Accounts receivable. Accounts receivable refers to the amount that is due when sales take place and is allowed by the buyers to the seller while conducting business on credit. It is an anticipation of the payment that has to be received by the debtors within the time period allowed for making the payment. The process of account receivable management requires effective and accurate handling to ensure the collection of accounts receivable in time. As accounts receivables form a major part of the company's asset, it leads to the generation of cash inflow for the business. Accounts payable. Accounts payable called as short-term debt payable within short periods of time and is treated as a current liability by the entity that has to make the payment. It is the money owed by the businesses to its suppliers for the goods purchased or services consumed. The accounts payable needs to be managed effectively as it enhances the short-term cash flow position of the business. This can be done by deciding on an optimal timing for payments to the supplier. Cash management. Cash and cash equivalents is the most important current assets that be managed under working capital management. Being the most liquid form of asset, it has to be effectively and efficiently managed to maintain company's financial stability, meet the unexpected expenses and also handle the regular operational expenses on time, such as payroll. Further, managing cash rightly also helps to maintain company's rating and avoid insolvency. Here cash includes both cash and cash equivalents. Working capital divided into two categories based on capital. Gross working capital. Investments in current assets must not be either excessive or inadequate as it can threaten the production capacity and the solvency of the company. It also undermines the profit of the business. Net working capital. Net working capital is crucial for maintaining a position of liquidity and to make sure that current assets exceed current liabilities. This is also the number that gives the creditor a clear picture into the financial soundness of your business. Based on time period. Fixed working capital. It is that portion of the total capital that is required to be maintained in the business on the permanent basis or uninterrupted basis. This working capital is required to invest in fixed assets. The requirement of this type of working capital is unaffected due to the changes in the level of activity. Variable working capital. It is that portion of the total capital that is required over and above the fixed working capital. This working capital is required to meet the seasonal needs and some contingencies. The requirement of this type of working capital changes with the changes in the level of activity. Documents required to obtain working capital. Nature and size of the business. Production policy. Seasonal variations. Production cycle process. Working capital cycle. PAN of company. Partnership deed or certificate of incorporation, as the case may be, bank statement for last 6 months, last 3 years income statement along with audit reports, if any. Collateral-free loans. The loan provides by the bank without supporting any security is known as security-free. Small business and MSME enterprises can obtain collateral-free loan from banks under various schemes promoted by the government to boost entrepreneurship and small businesses in India. Under this scheme, the micro and small enterprises, MSEs, are eligible for collateral-free loans up to Rs 1 crore. A special type of collateral-free loan scheme is available in India under the Credit Guarantee Fund Trust Scheme for Micro and Small Enterprises, CGTMSE. Under the CGTMSE scheme, loan of up to Rs 1 crore is provided for entrepreneurs without any collateral security. CGTSME scheme. CGTSME is an initiative made by Government of India to help for startups and SMEs to get collateral-free loans. This scheme is launched in the year 2000 by the Ministry of MSMEs. First, we have to check the eligibility for availing loan under CGTSME scheme. Under this scheme, the loans are given through member lending institutions, MLIs. All leading banks offer loans under the scheme. The following are important points under CGTSME scheme. 1. CGTMSE scheme is aimed at providing collateral-free loans to small businesses. 2. Loans under this scheme are available to SMEs in both the startup as well as existent phases. 3. Under the scheme, loans offered to SMEs are collateral-free. Small enterprises are not required to bring in their own collateral to avail loan. 4. Loans can be obtained for working capital requirements, purchase of machines, expansion plans, etc. 5. It is to be noted that small businesses involved in retail trade are not eligible for this scheme. The loan under the scheme is disbursed through member lending institutions, MLIs. Guarantee fee and annual service fee need to be paid by the borrower, who avails loan under the scheme. Documents required to obtain collateral-free loans under CGTSME scheme. Product development expenses, procurement of computers, procurement of plant and machinery, tools, etc. Share allotment proof, share purchase agreement. Bank loan syndication. Capital in the form of debt or equity is one of the fundamental requirements for starting, managing and growing a business. In India, it is easy for most businesses to syndicate capital in the form of debt from banks, as banks have a strong mechanism for evaluating and disbursing funds. Bank loan syndication is the process of involving several different lenders in providing various portions of a loan. Loan syndication most often occurs in situations where a borrower requires a large sum of capital that may be too much for a single lender to provide or outside the scope of a lender's risk exposure levels. Syndicated loans arise when a project requires too large a loan for a single lender or when a project needs a specialized lender with expertise in a specific asset class. Thus, multiple lenders work together to provide the borrower with the capital needed. Syndicating the loan allows lenders to spread risk and take part in financial opportunities that may be too large for their individual capital base. Interest rates on this type of loan can be fixed or floating. How does syndicating the loan works? In cases of syndicated loans, there is typically a lead bank or underwriter, known as the arranger, the agent or the lead lender. This lender may put up a proportionally bigger share of the loan, or it may perform duties such as dispersing cash flows among the other syndicate members and administrative tasks. The main goal of syndicated lending is to spread the risk of a borrower default across multiple lenders, such as banks or institutional investors. Because syndicated loans tend to be much larger than standard bank loans, the risk of even one borrower defaulting could cripple a single lender. Syndicated loans are also used in the leveraged buyout community to fund large corporate takeovers with primarily debt funding. Syndicated loans can be made on a best efforts basis, which means that if enough investors can't be found, the amount the borrower receives is lower than originally anticipated. Advantages. Syndicated loan facilitates competition for business by insinuating other banks to supply market information to a business in hopes of gaining recognition. Borrowers enjoy flexibility in structure and pricing, such that they have a variety of options in structuring their syndicate loans, including multi-currency options, risk management techniques, and prepayment rights without penalty. Syndicated facilities bring to the businesses the best prices in aggregate and spare the companies their time and effort that could have gone waste in individual dealing with each bank. Syndicate lending also increases feedback in the sense how the banks are willing to share viewpoints on contemporary issues about the business that they are otherwise unwilling to share with the borrowing business. Disadvantages: negotiating with one bank can take several days, which is a time-consuming process. Managing multiple bank relationships is an ardent task and requires investment both regarding money and time. Documents required to get loan: list of present shareholders, partners, directors, copy of PAN card or passport or voter ID card of all the promoters or directors or guarantors, photograph of all the promoters or directors or guarantors with signatures, certified copy of memorandum and articles of association or certificate of incorporation or partnership deed or registration certificate from registrar of firms or societies, as the case may be. Copies of the sanction letters for the present credit facilities to the company or associate concerns. Detailed project report if any. Audited financial statements for the last 3 years of the applicant unit, if in existence. Copy of the sale deed or lease deed of the collateral securities. Details about key managerial or technical personnels. List of present directors or partners with respective forms for the changes, if any, submitted with ROC. Business plan preparation. What is business plan? A business plan is a document that efficiently connects the business and its potential to those that matter. It could be a stockholder, a bank, a joint venture you want to work for your company. It will cover the background of the founding team, the business model, a brief analysis of the market and estimates of financial performance. Such a plan must be framed even if you are not looking to raise funding. Business plan is very essential as it serves as a roadmap for the business and provides information in an understandable format to investors wanting to know more about the business. A key use of a business plan or investor pitch is for raising private equity capital or angel investment in a startups. Business plans are used by private equity investors and angel investors to gain an insight into the business for making an investment decision. How to write a business plan. Writing a business plan is extremely imperative for a new business startup. A business plan is like a framework that will help you pen down the hows, when, where's and other several questions you might otherwise not even think of. An effective and well-written business plan is like accomplishing 50% of your business goal already. An elaborate business plan will help you make following: financial projections, identify opportunities, revenue generation, do a market study, perform a competitor study, plan for lean period or peak season for business, plan a course of action for the business with goals and milestones. Major parts of business plan. The following are major elements of any well-drafted business plan, so divide the business plan into these areas and work on them individually. 1. Table of content. The brief summary of business plan is given. 2. Executive summary. You write a cover letter comprising in short the details of your employment history. Similarly, an executive summary should comprise in short the idea of your business and how you intend to execute it in a succinct fashion. Your executive summary should comprise of a brief overview, company legal structure, business model, target market, key financial highlights, the management team details. 3. Business overview. You have to showcase the target buyers or users of your product in your business plan along with an overview of the market. This is one of the key segments in your business plan to elaborately mention who your target buyers or users will be. 4. Information about the member of the management team. Details of members of the management team to be explained fully. 5. Industry overview. You have to showcase the target buyers or users of your product in your business plan along with an overview of the market. This is one of the key segments in your business plan to elaborately mention who your target buyers or users will be. 6. Product or service information. You will have to be specific about the service you will offer or product sales you will be involved in. Type of food stall you plan on setting up. Does it have delivery or dine-in too? Is it fast food, snacks stall, etc.? The gadgets, instruments and utensils you will be using for preparation and selling of food. Type of packaging you will use for serving and packing. 7. Marketing plan. You have to showcase the target buyers or users of your product in your business plan along with an overview of the market. This is one of the key segments in your business plan to elaborately mention who your target buyers or users will be. 8. Company milestone. If any achieved, goals and accomplishments are possible only if you set the metrics and ensure they are met by the target date decided upon. Mention past milestones achieved by the business. Provide future milestones or product roadmap for the business. 9. Details of company financial plan. Financial planning is an important segment of writing a business plan. One of the traits of a successful business is keeping a track of how much money you are bringing in and how much is being spent. Forecast of sales. Prepare an income and expenditure statement. Prepare a balance sheet. Prepare a cash flow statement. Back up the above financial statements with detailed explanation of assumptions used, if any. CMA reports. CMA stands for Comparative Market Analysis. It is a vital tool for both buyers and sellers, helping you understand more about an individual property and the market it is being sold in. CMA report is often requested by bankers while sanctioning or renewing credit facilities. A thorough knowledge of the dynamics of property sales in the specific area is required to make judgments based on the data presented. Different bank loan facilities. The term loan is sanctioned by banks for the purchase of fixed assets like land, building, equipment and other types of assets. Repayment is fixed over a period of 5 years with EMI payments or bullet payments. The working capital loan is sanctioned by banks for working capital purposes like holding of inventory, receivables and build-up of other current assets in a business. Working capital facilities are renewable every year. Letter of credit is a type of facility from a bank guaranteeing a buyer's payment to a seller, in the event that the buyer is unable to make payment on the purchase as per terms of the transaction. CMA reports useful for the following. For buyers, this report helps to understand the value of your target property and potential price points that will be attractive to the seller. For sellers, this report helps to check the information being given to you by your agent and ensure your expectations for your property sale price are within the realms of the market. For investors, this report helps to understand what the property is likely to rent for and ensure your revenue predictions are made on an accurate basis. Documents required for CMA reports. Previous 2 years audited financials. Latest sanction letter, in case of renewal. Provisional financial for the current year. Term loan repayment schedule, if any. Details of proposed enhancement, if any, along with the terms and conditions. Bank loan rating. Bank loan rating from external agencies is used by banks, vendors, financial institutions, investors and others to gauge the financial health of an enterprise and its ability to make timely payment of its bank loan, including principal and interest payment. Further, to improve awareness about credit rating and its benefit, the Government of India also provides a subsidy for MSME businesses to obtain SME credit rating. Bank loan rating is used by banks to calculate the capital required by them for that loan. Bank loan rating is beneficial for banks, corporates, borrowers. The detailed explanation given below, benefits for banks, offers an independent and unbiased opinion on credit risk associated with loans extended by banks, enables computation of capital adequacy ratio (CAR) under the capital adequacy framework recommended by the RBI, provides risk-based pricing of bank facilities, inculcates financial discipline in borrowers, ensures quicker processing of loans and enhancements, offers an independent view of the borrower's strengths and weaknesses through a detailed rating report, provides a dynamic health check of portfolio. Benefits for corporates. Risk-based pricing of bank loans, lower borrowing costs for higher-rated entities, quicker processing of loans and enhancements, access to alternate avenues of funding, provide an independent view of the company's strengths and weaknesses through a detailed credit rating report, enhance visibility for the corporate in the investment community, avoid penal interests on unrated bank loans. Benefits for borrowers. Enables risk-based pricing, lower borrowing costs for competent entities, enhances visibility in the investment community, enables quicker processing of loans and enhancements, provide an independent view of the company's strengths and weaknesses through a detailed credit rating report. Credit rating agencies. CRISIL. Credit Rating Information Services of India Limited is the first credit rating agency of the country, which was established in 1987. It calculates the creditworthiness of companies based on their strengths, market share, market reputation and board. It also rates companies, banks and organizations, helping investors make a better decision before investing in companies' bonds. It offers 8 types of credit rating, which are as follows: AAA, A, good credit rating; BB, average credit rating; B, C, D, low credit rating. ICRA, Investment Information and Credit Rating Agency of India, was formed in 1991 and is headquartered in Mumbai. It offers comprehensive ratings to corporates via a transparent rating system. Its rating system includes symbols which vary with the financial instruments. Here are the types of credit ratings offered by ICRA. Bank loan credit rating, corporate debt rating, corporate governance rating, financial sector rating, issuer rating, infrastructure sector rating. CARA, Credit Analysis and Research Limited, CARA, offers a range of credit rating services in areas like debt, bank loan, corporate governance, recovery, financial sector and more. Its rating scale includes 2 categories: long-term debt instruments and short-term debt ratings. UNICRA, an individual credit rating agency of India, established in 1993, which offers credit assessment and credit scoring services to both individuals and businesses. Along with this, it also offers risk assessment reports to individuals, small and medium businesses and corporates. Its ratings are based on 2 factors: financial strength and performance capability. SMERA, Small Medium Enterprises Rating Agency of India Limited, has 2 divisions: SME ratings and bond ratings. It was established in 2011 and is a hub of financial professionals. It offers credit ratings in the following format: AAA, A, low credit risk; BB, moderate credit risk; B, C, high credit risk; D, defaulted. Brickwork Ratings India Private Limited, headquartered in Bangalore. This credit rating agency is responsible to rate bank loans, municipal corporation, capital market instrument and SMEs. Other than this, it is also responsible to grade real estate investments, hospitals, NGOs, MFI, etc. It offers various rating systems depending upon the different financial instrument. Documents required for bank loan rating: copy of income tax, GST, excise and wealth tax returns, if filed; copy of the audited accounts for the last 3 years. In case of new project or expansion, a copy of the project report containing a brief project profile, cost of the project, source or means of finance, details of subsidy and tax concession available, if any; quality certificates, authority letter to sign the application. Credit score check and repair. A credit score is a 3-digit number indicative of your credit behavior. Consider it marks given to you by financial institutions for your financial behavior. A high score means you have good money management skills and that you repay your debts on time. Likewise, a low score raises questions about your financial credibility. CIBIL is one of the oldest and major credit bureaus in India that generates a credit report along with a credit score that defines credit worthiness of an individual. If you have been paying credit bills and loan amount on time, then you will have a high credit score. High credit score means that there are more chances to get a loan at a considerate interest rate. Important points: India has 3 credit rating agencies, namely CIBIL, Credit Information Bureau, India Limited, Equifax India and Experian India. These rating agencies regularly collect information from creditors, lenders, utilities and other debt collectors to process the data into a readable and usable form and provide credit information reports on individual consumers for lenders. These credit reports plays a critical role in the loan application process. So, if you maintain a good credit score, the lender will look at other factors, such as your repayment capabilities and so on, while if you have a lower credit score, the lender will show reluctance in offering you loan. Documents required for credit score check. 1. Identity proof. Any one. 2. Address proof. 3. Electricity bill. 4. Income proof. 5. Certificate of incorporation. For companies. Benefits of a good CIBIL score. 1. To get loan approvals. When you apply for a loan, the lender will check your credit history before giving you the credit. 2. To avail loan at lower rate of interest. A high credit score can also help you in getting a loan at lower rate in case of personal loan where the interest rate on loan varies over a wide range. 3. For the fast dispersal of loan. A high credit score will help you in getting a loan approval faster. Faster approval means loan dispersal will also be faster. If your credit score is low, follow the steps to increase your credit score. 1. Paying off unpaid dues. Any credit card balance should be removed at first instance, so try spending as much as you can repay within the billing date. It's always recommended to close your loan account by paying off any unpaid dues. Your unpaid dues or heavy balances on credit cards may pull your score down. 2. Dispute resolution. Any error in your credit report may be disputed immediately with credit bureau after reviewing your CIBIL report, or if there is any discrepancy in record with respect to any loan or credit card. Any financial institution may resolve to your dispute within approximately 30 days. 3. Do not close your oldest credit card. We all think of closing down our old credit card accounts that we hardly use. But to increase your CIBIL score, you should not close any older credit card, which may result in decreasing your credit score. Actually, a good credit card account that you have managed well is with timely payment is an added advantage. 4. Maintain your credit utilization ratio. Usage of your credit card should be limited to certain important transactions. Moreover, one should keep his or her credit utilization ratio below 30 to 40% to avail loan on lesser interest rates. Also, by keeping your monthly balances low, you shall see a rise in your CIBIL score. 5. Increase your credit limit. When you request your bank to raise your credit limit, it does not necessarily mean that you get a chance to spend beyond your means. If your credit history is good, then your lender may increase your CIBIL score. Therefore, this hike in your credit score may have number of plus points stored for you in future. 6. Avoid applying for multiple loans. Avoid making multiple applications for loans simultaneously. It will depict one as a credit-hungry person and affects credit score negatively. Keep the percentage of loans in your portfolio lower by avoid applying for unsecured loans. As unsecured loans have a higher interest rate, a higher percentage of unsecured loans shows higher burden on your finances and thus impact your credit score. So, you can build a higher credit score by keeping the percentage of unsecured loans at a lower level. Credit report includes name, date of birth, permanent account number, PAN, Aadhaar number, additional identity proofs like driving license, voter ID, etc. Current and previous residential addresses and employers' details, if any, income tax information availed through previous ITR filings, dates on which your credit report was pulled by lenders to determine loan or credit card eligibility, information related to overdraft facilities available with your banking accounts, etc. Secured loans. A secured loan is a loan in which the borrower pledges some asset, example, a car or property, as collateral for the loan. Then it becomes as a secured debt owed to the creditor who gives the loan. The debt is thus secured against the collateral. In the event that the borrower defaults, the creditor takes possession of the asset used as collateral and may sell it to regain some or all of the amount originally loaned to the borrower. Benefits of secured loans. 1. Financial flexibility. Loans allows you to meet a financial requirement or expenses you incur in life. 2. Easy availability. Based on details of income, financial history of the borrower, and in some cases based on collateral. 3. Get required amount. Based on your income and financial history, the amount you require as loan can be disbursed to you. 4. Convenient tenure. The tenure of a loan is ample depending on the bank and amount. 5. Tax benefits. According to the Income Tax Act of 1961, almost all types of loans offer tax benefits which you can avail. Advantages. You can borrow larger amounts because lenders are confident that they will get their money back, either from loan repayments or sale of the property. Secured loans typically come with a lower interest rate than unsecured loans because the lender is taking on less financial risk. Some types of secured loans, like mortgages and home equity loans, allow eligible individuals to take tax deductions for the interest paid on the loan each year. Disadvantages. The personal property named as security on the loan is at risk. If you encounter financial difficulties and cannot repay the loan, the lender could seize the property. Typically, the amount borrowed can only be used to purchase a specific asset, like a home or a car. Home equity loans are an exception to this rule. Documents required. You will, of course, need to submit a bunch of documents to the lender or bank, so that they can establish your identity, address, and other details. Different kinds of secured loans are mortgage loan, car loan, home loan, business loan. Documents required for mortgage loan. 1. Proof of identity, driving license, passport, voter's ID, PAN card. 2. Proof of age should be a verifiable document that determines your age, such as a birth certificate, passport, voter's ID, etc. 3. Proof of income for salaried individuals, 3-month salary slip, Form 16 and bank statement. For self-employed individual, IT returns for last 2 years along with computation of income tax for past 2 years certified by a chartered accountant. For self-employed non-professionals, IT returns for last 3 years along with computation of income tax for past 2 years certified by a chartered accountant. 4. Proof of residence. This should also be a certified document that verifies your residential address in the eyes of the law. 5. Original property documents, bank statements for 6 months. Documents required for car loan, home loan. 1. Proof of identity, driving license, passport, voter's ID, PAN card, pro forma invoice of the vehicle to be purchased or quotation, in case of car loan. 2. Proof of age, should be a verifiable document that determines your age, such as a birth certificate, passport, voter's ID, etc. 3. Proof of income, for salaried individuals, 3-month salary slip, Form 16 and bank statement. For self-employed individual, IT returns for last 2 years along with computation of income tax for past 2 years certified by a chartered accountant. For self-employed non-professionals, IT returns for last 3 years along with computation of income tax for past 2 years certified by a chartered accountant. 4. Proof of residence. This should also be a certified document that verifies your residential address in the eyes of the law. 5. Property documents in case of home loan. Bank statements for 6 months. Documents required for business loans. 1. Proof of identity, driving license, passport, voter's ID, PAN card, Aadhaar number. 2. Proof of address, electricity bill or telephone bill or rental agreement or lease agreement. 3. Proof of income, bank statement of last 2 years. 4. Financial documents, last 2 years ITR along with computation of balance sheet, income and profit and loss account for the last 2 years. 5. Proof of business continuation, certified true copy of memorandum and articles of association. Unsecured loans. One can avail of a loan without any collateral or security for a pre-decided period of time at a particular rate of interest. The loan is issued on the basis of your ability to repay the loan. You might have to provide information about your income, savings, employment, or credit history. Some common types of unsecured loans include credit cards, student loans, and personal loans. Advantages of unsecured loans. 1. You may be eligible to get an unsecured loan even if you do not own property to put up as collateral. 2. The application process for an unsecured loan often goes much more quickly than the process of getting a secured loan. Disadvantages of unsecured loans. 1. Typically, interest rates on unsecured loans are higher than rates on secured loans because the lender has a higher risk level of the loan not being repaid. 2. Unsecured loans may be difficult to obtain if you do not have much positive credit history or don't have a regular income. In this case, you may need to find a co-signer with good credit history and solid income to sign the loan documents with you. Documents required for salaried individuals: identity proof, PAN card, Aadhaar number, driving license, voter ID, etc. Address proof, electricity bill, telephone bill, gas bill, etc. Bank statement for last 3 months. Recent salary slip or current salary certificate. Latest Form 16 issued by employer to employee. Documents required for self-employed individuals and working professionals: identity proof, PAN card, address proof, electricity bill, telephone bill, gas bill, etc. Bank statement for last 3 months. Latest ITR along with computation of income, recent balance sheet along with profit and loss account, CA certified or audited, for the last 2 years. Proof of continuation, certificate of registration of business. Thank you for watching.